Welcome to the Cashflow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
All right, welcome to the Cashflow Project. I'm your host, Matt Callahan of Tri-City Equity Group. Today we have Noel Walton on the show, and with me is my co-host, Vince Gethings. Noel Walton is the president of Eagles Capital. He's a commercial multifamily investment company. He's also an Army aviation officer with over 20 years of military service. Him and his wife, Claudia, began real estate investing in 2012 and have since managed numerous fix and flips. They hold a portfolio of single-family rentals and are passively invested in 50 apartment units. They began investing in multifamily real estate to reach their goal of financial freedom due to its scalability and long-term wealth opportunities. Noel draws from his experience in past investments, decision-making as a UH-60 Black Hawk pilot, and military leader, and conquering fear as a skydiver. That's pretty wild. Together, they have two daughters, Hannah and Julia. They have a passion for giving back to causes such as assisting children and homeless, struggling veterans. Noel, welcome to the show.
Hey, thanks, Matt. Thanks for having me.
So we're going to just kind of jump right into these questions. We've been chatting a little bit already. But so how did you get started in your journey to earn passive cash flow? I mean, it sounds like you started with, like Vince has talked about, the typical buy a house every time you move with the military. But how did you really make that jump to commercial and realize that truly passive cash flow was the way to go?
Yeah, I mean, really got started with the single families after some time in the military, and really about halfway through my career, I should have started much sooner, but it's got started with that, started making some progress with that, and really enjoyed it, and but just found that it was a lot of work for individual properties, dealing with tenants along the way that could be a serious headache. And actually, sometimes the tenants weren't as bad as the property management companies that we would have in place. I found that to be a really a big challenge for us, especially as I got through flight school, rented out the house that I owned in right outside of Fort Rucker, and had a property management company that we thought, hey, this will be great, hands off, get cash flow. Well, it turns out we were managing that property management company and correcting their mistakes, catching various instances where they were overcharging us for work, giving us ridiculous quotes on work that once we found quotes ourselves were half or less, and it just felt like we were getting ripped off. And, it was a huge headache having to deal with, and especially from being in Hawaii where we were. And, eventually it got to the point where, it's difficult to find a manager you can trust that's going to do a good job. And then, of course, you have the headaches of tenant issues occasionally. Even if you do have good tenants, you could have, for instance, we had literally after we PCS'd from Hawaii and arrived in Texas, literally on the drive to Texas, we got a call that from our tenant in one unit that we decided we were going to self-manage since we just left Alabama. They called us up and they said, hey, guess what? We flushed the toilet, it overflowed, and it's running down into the kitchen below. And we're like, wow, this is lovely. This is good stuff. So, you get all these things over time that add up. And then, but you kind of overlook it at first. You're like, okay, we're making cash flow, we're building some equity over time, and but then you start realizing like you can't scale this. And I didn't really realize what scale meant until I started really looking at multifamily properties, and they seem so daunting at first. You see these big apartment complexes, and even something as small as 5 to 10 units. Like, oh man, how do I manage this? How do I do the numbers on this? And, it just seems like something that, okay, I need lots of money to get into, or I need to be a millionaire to buy something like this. You get these ideas in your mind without even really verifying what it takes, and I think so many people tend to do that, where like they go with what seems easier or what they think they can handle versus let me do some research on this and educate myself and see what it takes. And I started, really hitting the forums, talking to people, different places, and met some operators in the space that, had been in multifamily, made the same transition for maybe two to 3 years tops. And these guys were leaving their W-2 jobs and, completely financially free. And it just blew my mind. I'm like, 2 to 3 years in single family, I might get 5 or 6, 7 properties being active duty military that I have time to deal with, and these guys were on the side, just cranking out huge apartment complexes. And it just blew my mind. I was like, I got to learn more about this. As I did some research and, attended, boot camp for a pretty well-known teacher, mentor, author, educator on multifamily syndications, really started learning a lot more about how it works and realized, you can scale these multifamily properties so easily, and they benefit more than just investors, multiple investors, but also multiple residents as well. And it was a no-brainer at that point. I knew I had to go all in on this, and that's what I've done.
Yeah, it seems like residential, what starts out as passive cash flow, gets pretty active pretty quickly for not much return. You even had your own toilet story. We talked toilets and tenants. They could literally interrupt anything you're doing and say, "Oh, my house is flooding with toilet water. What are you going to do about it?"
Yeah,
and that's on you. I'm curious.
And one of the things that comes up, and it's usually a lesson learned the hard way when dealing with residential property managers, is most people don't realize that most of the property managers, when you're dealing with smaller product like this, the single families and even the 4 units and stuff like that, is the property manager is not a professional property manager 9 times out of 10. They Absolutely. Are a real estate agent inside a brokerage that happen to inherit the problem of property management at some point down the line. And you see this a lot of, most of your property managers are going to be like this, like they're Remax or whatever the brokerage is. And, the owners got into a situation where they, or some of their clients got in a situation where they're moving and they want to keep the property or whatever. They couldn't sell it because the recession turned. So they turned to their brokerage of like, can you help me solve this problem? They're like, of course. We'll manage it, right? And that's how they now their property management company arm gets created from this impetus. So that is how most property management companies start, with these small residential properties. And because of that, they're essentially they're not trained, right? They're not CPMs. They haven't gone through formal education. They're real estate agents that now have an additional duty of being a property manager. And they don't know the process. Their plan is always going to be, let's keep rents below market and tenants happy, so I don't have to deal with anything. And the person that's flipping the bill for that is always going to be the owner. They're the ones that are, as soon as the tenant calls, they're like, "Oh yeah, I'll send over the maintenance man. I'll send over whatever." So you're getting you're just getting nickel and dimed and outrageous charges on the maintenance side of it. Like you said, that they're just $100 to have the handyman go out there and change a light bulb and things like that. And that's just constantly, digging at you and your bottom line. So you're not actually making money. You get some tax write-offs and maybe some equity from the debt pay down, but that's not nearly taking advantage of all of the, the benefits of real estate. Right. So that's mainly the trap that people, no matter how many times you tell them, they got to just figure out for themselves. And some of them, they take the advice. A lot of them, they just have to start with the small properties, and they have to see that it's not efficient, and you have to scale. And the other part of that is, it really is easier with bigger properties for the exact same point. Is with the bigger property, 50 unit, a 30 unit, whatever, 100 unit, is your top line revenue is much higher. So you can afford to hire better people, and you can afford to hire or to buy better systems. Like for when I was doing my 20 units, when I first started, I had 20 units, and I couldn't, even with 20 units, I could barely afford a bookkeeper. So I was still doing that was like, after 2 years, I could afford a part-time bookkeeper, virtual bookkeeper. And that was like, this is the best thing ever. Like, I'm not having to reconcile my books every month. But when you're dealing with a 50 unit, it's like, or 100 unit, it's of course I'm going to have a bookkeeper. Of course I'm going to have a lawyer on retainer. Of course I'm going to have a CPA. You can afford all of those things. It's in the budget. And that's what a lot of people don't realize, that it's actually easier doing the bigger properties, because you can just afford to be around and hire professionals. This is what they do. You have a property management company that's all they do is multifamily properties, and they have systems, they have all the processes, they have the staff, they have it down to a T, and they know exactly what your business plan is. And they're going to be doing it at 4% versus the single family who's doing it at 10%, right, of gross revenue received. So it's one of the points I want to make, that that's why it's easier, because you're dealing with professionals.
Yeah, so true.
Yeah, good points. So I wanted to ask, there's a lot of noise as far as investments go, especially in the military, Forex and Bitcoin and stock market. How did you decide that, real estate was the path to achieve your goals?
Really, it's just a no-brainer. Real estate has been consistent. It's stable. It's a stable asset. Multifamily in particular is very recession-proof. It's proven itself even through the 2008 timeframe, and single family took huge hits in value. People were losing their homes, but multifamily properties, they're not valued the same way. They're valued off of how they perform. People weren't foreclosing on those because generally more people were having to go rent at that time. And, that drives that demand for apartment buildings. So, plus you have a physical asset to back up that money. It's not just some numbers on a screen with stocks or Bitcoin or whatever the case is, and those can be great for short term. If you know what you're doing and you research it, know how to get in and out, read the signals, great. That's your thing, but for long-term wealth and, just high returns that are stable and long-term, cannot go wrong with real estate.
No, I couldn't agree with you more. And you touched a lot of the big points about why we kind of push multifamily as forced appreciation is kind of the biggest thing for me. And that's usually when I see the light bulb for people is, what about, the economy right now is not looking great, or 2008 bubble. Well, the other point that you talked about is, it's a basic need. People need a place to live. So even in an economic downturn, like people might downsize, but you're always going to have customers. Like people always need a place to live. You can force that appreciation. And it's just, I love it.
Yeah, absolutely. And then, of course, there's the tax benefits too. I didn't mention, there's huge tax benefits there that you will not get in really any other asset or investment.
Yeah, absolutely. So I kind of digging a little deeper into Noel Walton, your why for wanting to build passive cash flow. As a military guy, Vince and myself also, a lot of people were just like, hey, I'm going to do my 20, I'm going to get that pension, and that's it for me. Why do you want to build passive cash flow? Why more?
Because, I started out enlisted and seeing really that, everybody that I worked with that would retire, as, senior enlisted, they get out and they had to get another job. There's really no option, to be able to keep up with the cost of living, especially where I was around DC area. It was one of these things where, I got my retirement, but it's only paying like maybe their food and their car payment, for some of them, just basic living expenses, which is great, but they don't have the time freedom. They still have to go work full time, and they are essentially a slave to an employer their whole life. And to me, I started seeing that. And of course, for me at first, part of that is what drove me to, I need to go get a commission to be an officer, and then I can make more money. And then, but it's still that's ties into that same mindset of make more money to be more wealthy. And it's not really a true, I guess I would say, it's not really the case of how money works. No matter how much money you make, it's not about what you make, but what you keep. And be able to have money work for you and leverage your time. That's where the true wealth and the freedom is at. And that's what I over time, once I started to understand that through education, that's what I began pursuing and realized, hey, I need to be putting my money into real estate investments that will pay me back and continue paying me to add to that military retirement and create the passive income that allows me the time freedom to invest in other people and into other causes and into my why, which predominantly number one is my family and my wife, my 2 daughters, and really giving them great opportunities in life, giving them memories to take with them the rest of their lives. set them up for success. And also, you know, in addition to have the time freedom to travel, you know, my wife is from Austria. And so that's one of my second home, really. You know, we go over there once a year and have that freedom to travel, go see the rest of the world whenever we want to. That's on our list for the future. And, you know, go skydive whenever I want, you know, not have the job telling me I need to be somewhere at a certain time. Can make my own schedule, you know, I just have the options. And that's really what it comes down to, is having options in life and having the ability to help other people.
Yeah. No, I'm glad that you mentioned that too, because so many people, I think, in the military have that same realization. I just like you, I was enlisted 8 years, and then I decided, you know, I needed to make some more money. I'm going to seek a commission so that I can make more money to make more money. And then Vince was kind of the other side of that. He had that same thought, but then he was able to go ahead and replace his W-2 income so he can go full time into real estate as opposed to seeking a commission. Because I know in the Air Force it's a little bit different for whenever they want to commission it. And I'm sure he could talk about this a little bit.
Yeah, absolutely. And to the point of your comment of like having your peers and everything like that, just when they get out and having to get another job. So I had the opportunity to go to TAPS, you know, Transition Assitance Program. For y'all that are listening, I don't know about that, aren't in the military, but it's a class that we have to go through as we start that transitioning process out of the military to see, you know, what, you know, the big world's like. And I went through at right around my 10-year mark. And that was because the supervisor told me, you need to go to TAPS. Even if you don't plan on getting out, start now, not when you're at, you know, 6 months out at your 20-year mark. So I went through TAPS, and I'm sitting in a room with a bunch of people that have put in decades, you know, 20 years, 15 years, you know, 30 years. And, you know, the first day, it's a week-long course. The first day, everybody's kind of, I'm going to be, you know, the running jokes like a greeter at Walmart or whatever, or Home Depot. And then by day 3, you see a bunch of stressed out, you know, middle-aged people sweating when they realize that their pension's not going to be enough to live a fulfilling life off of. It'll cover, you know, usually the basics, you know, the mortgage, insurance, maybe a car payment or something like that, but far from an inspiring lifestyle. And then the other side of that is then they realize, oh crap, I need to get another job. And then, oh yeah, I'm not that marketable because I am 40 something years old. And yeah, I might have a degree, I might have, you know, skill set, but when you're looking at an employer, you know, why would they're going to have the thing of like, this guy's about to retire in, you know, 10 years. He's not going to be the longevity in this company that we need. So then they start realizing, like, yeah, I might have all these boxes checked on my resume, but I'm still like, you know, 50 years old. And why would a company hire me over, you know, a 26-year-old MBA, still has the fire, still can be with the company for 20 years. And then they start realizing that around day 3. So luckily I had that, you know, I've been immersed in that experience at my 10-year mark. And that's right around when I was like, this is not as rosy as, you know, this might've worked. This, you know, the 20-year pension might've worked, 20 years ago, you know, back, you know, before the internet age and everything, the information age. But it is not looking like it's going to work much. And people need to be more proactive about their financial planning, their legacy, what they're going to do with their family. Because I'm telling you, the bullets getting sweat on, you know, day 4, day 5 of TAPS was enough to sear into my brain that I need to take massive action now. And I did. And now, you know, I'm going to be transitioning out of the military at 15 years rather than doing the 20-year and getting the pension. So because multifamily real estate has provided that opportunity for my family and is essentially giving me the freedom to do what I want, when I want, with who I want, where I want. So that is very, very powerful stuff. I'm going to transition back over to Matt.
I want to switch gears a little bit. We've kind of talked about why multifamily, how you got into it. I want to hear about your most recent deal, how you found it, how it's structured, how you participate in it.
Okay. So I got to be selective with it being a 506B, but I'll keep it kind of broad. Most recent deal, you know, it was found through a broker relationship, and obviously those are valuable. You know, be able to meet multifamily brokers that will take you seriously and be able to develop the trust with them is huge. That's where the difference between them sending you details on a crappy deal versus one that actually has good potential And that's where we're at with this one. And, it's 100 plus units, good size, great ability to scale, rents under market, room for huge increases to NOI with expense reduction, income increases. And we're excited about all of that. We basically, put this together, structured it as with a preferred return to our investors, and then an equity split above that. And, bringing in passive investors, basically, a lot of people like to see a preferred return up front, and we like to put those into our deals because that aligns our interest with the investor's interest. And that ensures that we, as the general partners, are not paid anything until those limited partner passive investors receive their preferred return. Could be anywhere from 5 to 8%. I've seen some people do up to 10%. But in general, you'll see about, probably a 6 to 8 is kind of the average. But you guarantee this is what you are going to receive in cash flow first, and then cash flow above that will then get split into whatever your equity split is. And those can vary from, a 60-40, 70-30, to the higher number to the investors and lower to the general partners. So that's generally how we structure our deals, and making sure that we can, we have certain minimums that we strive to achieve for our investors. We won't even go into a deal if we know we can't meet, a certain minimum. Generally, 10% average cash on cash over the life of that hold, or and a 15% internal rate of return. So we look for at a minimum to be able to hit those marks and potentially exceed those.
I heard one of Vince's buzzwords. He is a master of reducing expenses. We talked earlier about forced depreciation, and that's one of his favorite ways to do it, is to get rid of some of those expenses. Just because reducing expenses, those dollars are not the same color as increasing profits. Not profits rather, but income.
Yeah, for Absolutely. Sure. And that can be it's easier really to cut expenses on most properties than, especially in a COVID market, for instance, being able to raise rents significantly, and when people's jobs are in the brink, people are having a hard time with their money. It's raising the rents it can be tough. You may experience some vacancies and things like that. So, be able to take advantage of that NOI increase through the other side where it's not affecting your tenants, and whether it be through the utilities and things like that, those are always great options.
Yeah. So you've been closed this deal and you're running it during COVID. Have you faced any obstacles because of it?
So we've been in obstacles throughout this one, and we're actually about a month out from close right now. And, it's just first real big syndication. So it's been some great learning experience in here. In this one, we're aligned with a good sponsor, and he's got some great experience in the business. And, it's for sure. There's always challenges along the way, and we've learned something new from it. The previous deals that we've worked in, we've actually encountered a couple hurdles earlier in the year around the summer time frame. And one in particular was 18 unit. We put a LOI, our offer in on that, and it was accepted. The seller was apparently in a very big hurry to sell. And we were working on putting our contract together, and by day 4, they didn't receive anything back. So they said, "Oh, guess what? We're not taking your offer anymore. We're going with somebody else's offer," and just backed out on us. So, we were not too happy about that. And, but, you can't really help sometimes when certain sellers are very particular, or they have, they're just, some people just different, so we obviously adjusted our processes to try to make ourselves faster in the future and hopefully avoid that particular sort of situation again. Then shortly after that, we actually got under contract with what was advertised as a 52 unit, got into the due diligence, discovered there was actually only 50. That one was, one of those supposed units was the maintenance storage, and another one was the leasing office. So that definitely changed the returns a bit.
Yes.
Are you sure you haven't been following our last couple deals?
Yeah, no, I was like that same exact thing happened to us.
Back and forth sellers, unit count, not what it was supposed to be.
Yeah, exactly. That's once we got out there on site and started counting these and comparing it to the rent roll, we're like, whoa, something does not add up here. And so, we looked at that, and there was other factors as well. We looked at air conditioning units. Out of those 52 air conditioning units, there was roughly, I'd say at least 20 or 30 that had to be replaced. That were just not, and you're looking at, 3,000 roughly a unit. That drove our CapEx budget up. Multiple other things we found on site that we just had to add more capital to the CapEx budget, recalculated, and realized, hey, this offer price that we got accepted, we're going to have to retrade or renegotiate. And because of that, the seller just wasn't willing to budge on the price. But we had to walk away from it. We knew our numbers and just had to trust them. A little disappointing, but hey, it's how it goes sometimes.
No, absolutely. You did all the right things. And funny story for ours, to relate to the unit count for people that are listening, it's like, how'd you mess that up, right? So we recently bought a deal that was advertised as a 60, and we go there and we start looking around and doing our due diligence, same as you. And there's 57 doors, and I'm like, what's going on? And then we're looking at the thing. It's like, there's literally a door that says unit 60. And you're like, what the hell's going on? And I guess at some point in building this building, they missed 3 doors, like units it was 23, whatever, 13 and 17 don't exist. Like they just skipped those, like when they're putting the doors on the numbers on the doors or something like that. And yeah, it's those things that come up. There's no way to plan for that. There's no checklist for that, right? It's just like doing your due diligence, staying smart, staying observant and present, and consciously going through all these things, and you learn these weird little things that happen on deals. But it's awesome you caught it. And the other thing was, definitely wanted to catch on that was, this is definitely a marathon, and definitely persistence is the most important trait to have with multifamily investing, because you're going to have buyers that back out. You're going to submit LOIs that, even at asking price, they want 2 million, you write an LOI for 2 million, and then you never hear from them again. And then it can get very discouraging. Or they take your LOI and they go shop it around, and they're like, oh, just joking, price is now 2.4, right? That stuff happens. And you just have to roll with the punches. It comes with the territory. You have to stay persistent. And most importantly, don't bend your minimum criteria to make a bad deal work. You see a lot of people attempting to do that, especially if they're seeing, a bunch of people close deals around them, and they've been doing that. They've been trying to close a deal for 9 months, and they're getting discouraged, and they're like, we need to get something in the books here. So they get that itch, and they start like, well, maybe if we just tweak, this thing and this, my model like this, and we tweak this like this. And now, oh, look, I hit a, 15% IRR. I'm a genius, right? And work, but you did the right thing, and you stuck to your guns, your minimums, and you didn't buy a bad deal. And that's the most important thing you can do, because there's really no recovering from that. You can just hope if you did do that, the tide raises all ships, because that's pretty much the only thing going for you. Is the market you bought in will just appreciate and kind of save you from yourself. So don't find yourself in that position. Stick to your minimums. In the best way, if you know that you could do that, maybe I'm not, is always have a sounding board, always have a partner that is willing to kind of check you, have that accountability to kind of call the BS when you are doing a pro forma, and they look at it and you're like, no, I see what you did there. You were not going to hit a 4% income increase, next year. We're going to hit a 2%. That's what the market is, so it's good to have that second person always on your team to double check all your numbers and make sure you didn't miss anything. So, well, I'm hoping you do. You said you close when? In about a month, hopefully.
Yeah. Yep.
That's going to be big stuff. It's very, very exciting. So how have, now that you're closing a deal, we were recording this in January 21, we've been in COVID for 9 months now. Have you adjusted your underwriting, or how have you adjusted your underwriting from when you first started pre-COVID to now, as you're looking at deals? What changes have you made?
We've made it very conservative to account for, potentially a lot of tenants, losing their jobs or being cut hours or things like that can affect their ability to pay. We've really added in significant amounts of economic vacancy that we plan for from year one. Just assuming we're going to have late payments, we're going to have to offer concessions, things like that, offer a payment plan if somebody can't come up with a full amount. Those are the type of things that we take into account that, we don't want to have to evict or necessarily kick someone out if they can't make their full payment, but we want to work with them because obviously, vacancy turnover is a huge expense. So we want to, we want to be able to work with those tenants if they are literally having, really struggling with those payments to, work out what can you pay now, what can we work out later, come up with a payment plan so that, we can at least keep them in the unit and work through it and come out better on the other side. And obviously that's part of keeping the relationships with tenants as well, and that's what keeps you in good reviews and things like that from all your tenants. They can tell that, hey, this management or these owners care. And that's really what we want to convey and then make sure that they feel that way as well. Additional things we look for, we over the term of a loan, when we're planning our exit strategies, we want to plan for a cap rate on this property that is getting larger by the year. So, in the instance, for those who don't know about cap rates is, generally it's based off a market or a certain comparable property, and as cap rates get lower, values tend to get higher. So, in a good market where, say, for instance, you take an example of Dallas, Fort Worth, you've seen, the huge population growth, the economy growth, and those cap rates are decreasing significantly down to, 4s or even 3s in some places that, the big cities, that's what you will generally see. Whereas if you see that cap rate getting larger, then you're assuming the economy is probably getting a little bit worse. Also, it's tied to interest rates. Interest rates can also, as they increase, will tend to affect the cap rates as well. So, what we do is assume, okay, let's just plan that the economy is going to be worse as we own this over the next, 7 to 10 years. And if we do a refi, we want that cap rate that the refi is done at to be higher than what we purchased it at, and even higher than that at the sale. And if we still come up with great returns and it stays below those cap rates, we've just increased the returns that much better. And we've allowed that cushion for a bad market. Additionally, we look at keeping our year over year rent increases very flat and slow. So year one, we may only put a 0, maybe a 1% increase into our rent increases. We'll keep the expense increases and basically the inflation of expenses at a 2% throughout, and maintain everything else at a 2% as well to keep it really just in line with inflation, but not going up to what we generally would see. We expect to see sometimes a 2.5% or 3%, and in some markets even higher each year, which outpace inflation. So if we do see that, great, we've got a good surprise, and that's what we want to see is good surprises. But if not, we've kept it safe. Additional, one thing we do as well is what's called a stress test. And what we do is increase the vacancy level, the economic vacancy level of the property on our spreadsheet, and increase it to the point where we find out where do we break even to just paying debt and expenses, where our cash flow is 0. If we want to be able to achieve at least a 25% of a economic vacancy, and that, and if we can get better, if we can get it to a 30%, that means it's performing even better. So that gives us that cushion to know that if we get 25 to 30% of these tenants that just don't pay for some period of time, we know we're still going to stay afloat. We won't pull cash flow, but we will still be paying our debts and our expenses, and we can still operate. So that's a huge piece of the risk mitigation that we put in there that just as put in place there for the comfort of all investors as well.
Awesome. That was a lot of stuff. So yeah, a couple things that, I want to foot stomp is, rule number one is don't lose money. Right? And that's always thing is always protect, do everything you can to protect the capital invested of yourself and more importantly, your investors. That's always things. That's the importance of these stress tests is you want to do like the Swiss cheese model and poke holes through all your pro forma after you build them. Like, what are all the ways that this can go wrong? And 9 times out of 10, the deal is going to fall flat on its face. And then the one time, the 10% that the deal does work, you're like, holy crap, like the deal just passed a stress test. What did I do wrong? You start second guessing yourself. And then you're like, a couple hours later, you realize this actually might be a good deal. And that's where a lot of investors kind of separate themselves is, they figure out all the ways the deal can go wrong first, and then all the ways it's a bad deal first, and then they surprise themselves. Wait, this is actually a good deal. Then they're that much more confident in writing an offer and only buying solid product. So stress testing is extremely, extremely important. So it's awesome that you do that. What was the biggest, going on a little bit further, what was the biggest mistake that you've made so far in your real estate career? And what did you learn from it?
Yeah. So really, starting out, probably I would say just not buying properties at the right price. Early on, I had no idea what I was doing. And it was like, hey, it's a house. I can rent it out. I can live in it. And next thing I know, it's already a little bit above market, then the market drops and I'm, negative equity in this thing. And like, well, I have no choice but to hold this and just keep renting it out for cash flow. But it wasn't anything too major. I've tried to be very careful with each investment and, and even sometimes to a negative, being too careful to where you start the analysis paralysis and you just get stuck in, what about this or that? And you just don't ever take any action. That can be bad as well. So, it's really just with education, you start to know this is what I need to do to take the proper precautions. I've done that. Now I know I can move forward, or I know I need to back off, one of the two. You don't sit there and ruminate over it for forever and never do anything when it could actually be a great deal that you should be putting an offer in ASAP. So, yeah, I mean, as far as any major, things, I would say that's really it. Just, should have started earlier, should have known as I was going how to buy at the right price, because that's really where you make your money. If you can buy a discounted property, and, as far as single family goes, or, now in the multifamily, obviously having a lot more education. I know, hey, I need to know how can I evaluate this property accurately. So, but it's, haven't had any groundbreaking, losses and things like that. So, fingers crossed, going to keep that up. And, I feel like now with the education level I'm at and the experience level, it's going to get better from here.
Especially having, like you said, you're in a group, or you at least were in a group, and being around, the proximity of people that are doing this and people that are, further steps, ahead of you by a few years. Maybe they have 1,000 units or something like that. And being able to talk and brainstorm and use those people as a resource you can't put a price tag on that. So a lot of people, these guru groups and things like that usually get a bad rap. But man, if you can, you drop 20 grand, and that sounds like a lot, for some coaching program. But if they can save you from one thing, right, it's paid for.
Oh yes, absolutely.
The deal, the stakes we're doing here, we're not doing single family deals here. We're doing, we're writing $3, $5, $10 million contracts. So that 20 grand to avoid a couple pitfalls. It could be as simple as going with the wrong insurance policy. Like that alone could be, disastrous. But having that, that one thing of just the mentor, like, hey, when you're going for insurance, make sure you look at this, and this, it'll save you. Believe me, because I did it 10 years ago. I didn't do that, and I got slammed with a, $500,000, insurance penalty or something like that. So definitely there's a ton of value in in those type of groups. But
sure.
It's all about what you get out what you put in. So don't expect to go to them and just be like, teach me everything and I'm going to be a millionaire and you're going to do all the work for me. That doesn't exist.
Oh yeah, that's so true. And it's, it was one of those things that I was scared of doing at first. Is you think, I'm just giving them a ton of my money and I could go put a down payment on a property with this money, or, what am I doing? Absolutely. It's been I spent, 20,000 best money I've ever spent. Absolutely. By far. Just with the network, the mindset, the education I've received out of it, I would have no regrets. And it's put me years ahead in experience and education. And the mindset really is huge. It's 80% of what we do in this business. And without it, you're going to sit there and just not, like I said, not take action without having that right mindset.
Absolutely. You're stuck in your limiting beliefs of just like, oh, I can't do this. I'm just a whatever, XYZ, or this is the kind of socioeconomic situation I grew up in. So why do I think I can achieve better than this? And being around people that like, it looks like, Rod is one of your mentors, and it's like, hearing his story, and it's like, holy shit, like that's amazing. Right. And there's, many stories like that. And it's like, well, maybe I can do this. Maybe I can pull this off. And having people encourage you to do that is absolutely, you can't put a price tag on that.
Yeah,
so,
for sure.
I was just going to add, Vince,
you gotta jump and take a leap of faith.
Yeah.
I was just going to add, Vince, you touched on it, but coaching doesn't work unless you do. People will go out there and spend that 20 grand and say, I heard it on the Cashflow Project by, 20 grand is a drop in the hat for what's going to happen. Well, don't get discouraged if you pay 20 grand and you don't do any of the things your coach tells you to do, because they're not going to do it for you.
Yeah, that's spot on. You got to put the work in to make it happen.
Absolutely. So what, I think I got one more question here on my side, and then go back to Matt. From the military, now we're trained very differently than, corporate or anything else for that matter. What skills or training that you've received over your career did you surprisingly find out that like, wow, this is a skill set I have that transitions very well to this, to real estate that I wouldn't have thought of? Because I can have a few, but I want to hear what yours were as you transition. Now you're doing this much more.
As far as the military skills that I've carried over, to me, I would say the leadership skills that I've developed as an officer, and the team development, team relations, communication skills are huge. I helped co-found the JCORE partners, and there's 4 of us that are all military, or 2 of us that are current, and then 2 that are retired and former. And we each represent a different branch of the military. So we all think a lot along the same lines. We do very well together, bring different skills to the table, and we all complement each other's strengths and weaknesses very well. And that's been huge. But, for me, it's really helped me bring this team together, help put us on the right track together. You make sure we're on the same mission goals along the way. Are we each tracking what we need to be tracking week to week? And that's part of that team building, the goal setting, the communications, thinking through with whatever our current mission is, what could happen? What are our courses of action if this happens? Do we have something set up to account for this? It's just operational planning, risk mitigation. Let's see what else we got here. We got risk mitigation. I mean, it's countless. I mean, it's just seeing the operation, understanding what second, third order effects of your decision making. It all ties into and very much parallels the operating as a general partner in any active syndication or in a team as a whole. And I think it's, carries over quite well.
Yeah, absolutely. One for me, and you can probably appreciate that as well, is the use of just like checklists and processes. There's a lot of people that they're just winging it all the time. Everything's just up in their head. And in our group, I'm just very very much like, okay, we need it. And our partner Duke as well is like very much like, as soon as we come up with an idea, it's like, okay, we're going to document this process and we're going to create a checklist, and we're going to have some kind of mechanism. Like we use Asana for management, and it's going to be, systematized, and having that mindset of everything needs to have a checklist and everything needs to be systematized is very much second nature. And then definitely on the leadership. And I always thought, I was like, oh, I went to all like the PMEs and all that stuff, and that helps. And it does a little bit, but really I think sets it apart is in the military, we don't get to choose who our teams are. We are given teams and we have to make it work. So like there's no out on that. It's like, these are the people I got. I have to, motivate, inspire them. I have to get to the mission done. So you're forced to develop those skills. Where on the on the outside, it's like, I don't like working with this person, I quit. And then so you're not really forced to develop those leadership skills. So that was something that over the last year I kind of, especially with some of our partnerships, like realized that like I'm working through the process of the leadership skills and things like that, and tools and growing this team, the storming, the forming, all that. And realizing, this stuff actually does work. And it's just coming second nature rather than, forcing it. That was definitely one of the aha moments over the last year was of that leadership stuff. So that is great. Matt, it's over to you. I almost jumped in and started talking again, but I must.
Yeah. We'll cut you off there. Noel, we want to respect your time. And I'm about to move across the country in just a couple hours. So I'm glad we could squeeze this in, but I'm going to jump into a fire round. I'm just going to hit you with a couple of questions. And first thing that comes to mind, number one, what is the best book that you recommend other than Rich Dad Poor Dad?
All right. So I've been definitely been reading a lot of books this year. So that's it's a tough one. There's multiple books out there that are just great across the board. But a couple of them that really stood out to me was Mindset by Carol Dweck. A really good book there, going over the differences between the growth mindset versus a fixed mindset, and how to achieve that growth mindset and how it can help you in life. It's really good stuff. I highly recommend that. Another one was The One Thing by Gary Keller. Excellent book. Definitely highly recommend that. Helps you focus on without getting tied into too many things that are happening around you and all the multiple tasks that you need to do. What is the one thing you need to focus on that's going to make everything else easier? And it's an awesome mindset shift on that book. Those are just two. If anybody ever wants to contact me after and get some more recommendations, I can show you my whole list. But we'll go with those two for now.
And mindset is important. What is your superpower?
For me, it's definitely building the relationships with people, empathy. I like to really understand people, where they're coming from, how we can assist them, as operators in real estate. What are their goals? Really understanding where they're coming from, what drives them, and where, how we can provide what they need, and really understanding, because when it comes to being a general partner, you're going to have multiple investors, passive investors, and you have people there's certain things they prioritize or they value more than others, and the way they receive information. If someone is a relationship driven investor, they're going to be much more in tune with people who are along the same lines, that someone that wants to build that connecting relationship versus someone who's all about the returns and the money. You come at them saying like, hey, let me show you these returns before you even start getting into the relationship with this person to try to get them to invest. It's probably going to turn them off pretty fast, or they're not going to connect as well. So really, I try to implement that thinking and understanding. Hey, is this someone who's more of a numbers driven person, that like they're not as concerned with the relationship as they want to hear the numbers, or are they more relationship driven, or are they more process driven, things like that. So really understanding where they come from, what they value is huge as you start to talk to them, so how to approach and even when they do invest with you, how to keep them informed of what you're doing and what type of messaging you need to put out so that they understand more from their perspective what it is you're doing and how you're doing it to operate the property and keep things moving.
Awesome. And two extra resources that I would throw on top of that is the Pitch Anything by Oren Clough. That is an amazing book, and pretty much everything that you just said is in that book of going through like the different levels of the brain of, you can't just go in and just start like firing off like IRRs and equity multiples and stuff like that. Like, their brains are going to get, short circuited, and that is not good for you. So definitely that's an awesome book. And then the other one is Stephen Covey's, The Speed of Trust. That is a excellent book of understanding that everything is about trust. That needs to be at the foundation of everything, is build trust. People will not do business with people they do not trust.
For sure.
So it's very intentionally building those relationships on trust as the cornerstone.
Yeah, good stuff.
For the busy working professional or military member, if they're working towards financial freedom, what advice would you give them? Having been in those shoes, still in those shoes, I think one of the biggest challenges I've faced, and I know many others do, is the time management, and having multiple demands of family, your job, your real estate, trying to fit hobbies in there, all of that gets very challenging. So, what I recommend is, if you're getting into this, learn to time block, learn to prioritize, and get into really just figuring out what is your priority for each item. What do you need to do for that week, and sit down on a Sunday or whatever, just plan your week out, prioritize what is a no-fail mission in each of these areas, with my family, with my job, with real estate, what needs to be done, and line that up so that you're not getting distracted with the multiple ankle biters that pop up during the week. And you time block those, set those on your calendar and stick to them and say, this is the hour that I'm doing this. This is the hour that I'm taking phone calls. This is the hour that I'm doing this. Set that all up and stay strictly on that. When you're in those time blocks, turn off the phone. If you're not doing calls, eliminate those distractions. It's going to make you so much more productive. It will allow you to really focus the efforts where they need to. Another thing is build a team. If you're in this, don't do it alone. Especially multifamily, you have to have a team. But just to meet the what you need to get done, it's going to pay dividends for you. And it's to have someone that you mesh well with, someone, potentially strong in one area, another person strong in another area. You balance each other out, bring great strengths to the table, and you each work in roles that are in line with your strengths. And with us working as a team of 4, I found that not only was our productivity quadrupled, it was more than that. It's all of us using our strengths. I could put half the amount of time in, we were still getting 4 times as much work done as a team, and we all, same thing. We all realized, man, we're able to put more time into family and work, but we're getting a lot more done as a team, and especially with effective communication and enacting the processes like you were talking about. Processes are huge. We got together and put our communications up on Slack, and then worked in Trello into that for a project management side. So we have the visuals, what's going on. We can questions pop up and like, I can put this in the Slack chat. Somebody will get back with me in a little bit. All these multiple technological processes, and like you said, checklists, awesome. Everybody's on the same page. Everything is standardized, and that's going to save you a lot of time as well.
And it's not, a lot of these things aren't just like huge sweeping, like lifestyle changes you need to do. Like one of the biggest efficiencies, I'm huge on like Pareto analysis, right? So the 80-20 principle, and which is like, we're talking about the one thing, that a lot of this stuff can be like small little tweaks are going to have huge impacts on your time and efficiencies and effectiveness. For example, one of the best things I've done was turn off notifications to all of my apps. Like nothing will buzz my phone or any of those apps, Facebook or Instagram or any of those. like just turn them all off. Go to your settings, turn off all your notifications so you're not getting constantly bombarded by distraction. Like you said, those ankle biters. Other ones, easy ones I did, like the phone, I put on automatic sleep modes. So at like 8 p.m., the phone goes silent. So my phone doesn't ring. Everything's just going to silent. So I'm not, looking at my phone and not, people can't reach me, things like that. And it doesn't turn off till like, 6 a.m. the next morning. So I'm not getting random calls at 4 in the morning, things like that, or just that, distract me, things like that. So just there's small little things like that you can do that have huge impacts. Time blocking is absolutely huge. I was pretty good at it. I'm not going to lie. I would probably grade myself as like a C- this last year. Speaking of those ankle biters, I got 3 kids that haven't been in school in 9 months. So it's really hard to time block and focus when, you got 3 kids beating each other up all the time outside the door. So
with you there,
they're the best. It's great. They're back in school now. So slowly getting back to, what is considered normal. So the time blocking is absolutely huge. It definitely takes a discipline to do it, but just like any other habit, do for a few weeks and you really start reaping the benefits of doing those small little habit changes. So awesome input. Matt, you want to close out?
Yeah, I do. It was more like a slow burn round than a fire round.
Yeah, I get excited.
I know. No, it's hard not to. I did want to just ask real quick as we kind of wrap up. Who else that you know, or who would you like us to see? See us get on the show?
Well, that's a good question. Gosh, there's a lot of great people out there. I don't know if you guys have had Rod Khleif on before, but I'd say he has some great knowledge bombs to throw out there. He's and I think he's always willing to do that. I think as far as outside of real estate, just as more of the personal development side of things, Jocko Willink would be a good one. I think I heard him on the ADPI podcast as well, but his book is really good, and I think he'd be a great guest as well.
Vince and I met him. We'll have to reach out to him.
Yeah.
Nice. Very cool.
To Oahu.
Very cool.
Okay. Well, as we close this up, do you have any requests for our audience? And then how can they reach out to you if they want to know more about Eagles Capital or you?
Yeah, for sure. So our team, the JCORE partners, we do have a free passive investing guide on our website. And if you'd like to download that, you can go to JCOREinvestments.com, JCORE investments.com. And my email, you can reach me personally at Noel, Noel, at JCOREinvestments.com. I'd love to set up a call anytime. Just get in touch with me. I'm also on Facebook and LinkedIn as well. I'm always happy to answer questions, offer education, help out in any way I can.
Awesome. Well, for everybody listening, if you found value in this podcast, go ahead and please subscribe so that you can get the latest episodes. Hopefully Rod Khleif, Jocko Willink coming soon. And then we'd love it if you'd give us a rating and a review on Apple Podcasts, Stitcher, or wherever you listen to us. Pretty sure we're everywhere. And if anyone who might resonate with today's podcast, especially a lot of military members, kind of emulate what Noel's doing, share it with them. Share the episode. It's going to be on our Facebook, Instagram. And if you want to connect with like-minded investors, we have a Facebook group as well, the Honolulu Multifamily and more. And then as always, you can connect with us at tricityequity.com if you want to learn more about what we're doing and some of the guests that we've had on the show. So with that all being said, we'll see you next time. Thanks, guys, for coming on.
Thank you, guys. Appreciate it.